Let's look at the lessons from the great financial crisis. Quantitative easing, QE in theory. Well, the theory is very simple. Fed buy bonds, interest rate falls, stocks and home prices move up, and we have a wealth effect. People feel richer, they consume more. And if the Fed were to be printing a lot of money because they are buying these bonds here, when the Fed buy bonds, they are pumping money to the system. And if money supply grow tremendously, that weaken the dollar. A weaker dollar can create more export, theoretically. So all this, right, would add up to creating a stronger economy, more jobs. Looks great on paper. But when we examine the details, right, we see that the stock market became extremely addicted to all this quantitative easing. When the quantitative easing one, QE1 ends here, the stock market sells off. The Fed came in with QE2, and when QE2 ends, the stock market sells off, and so on and so on, right? So it is not healthy for the stock market to be addicted to the money from QE. The stock market should operate as a way that we value companies based on their profitability. Does the QE really create the wealth effect? Well, if you look at the overall data, you might support this notion because between the year 2009 to 2011, the mean net worth by household increased by 14%. So you will say, yeah, 14%, so some of this money could be spent and help the economy. However, the sad thing is that when we break it down by net worth group, we see that only the group that has a net worth of 500,000 and above, this is the group that has seen a very large jump in their wealth, up 21%. And everybody else actually were much poorer. Sadly, this makes sense because if the Fed's intention is to create policies that would make the stock market higher, who would benefit from this? Well, answer is the people who own stocks. Who owns stocks? Answer, the rich people, right? So one may suggest that QE had actually made the rich poor gap a lot worse. Moving back to monetary policy, what happened to all this money that's printed by the Federal Reserve? Well, we can see that the total reserve created had jumped up sharply, but the required reserve actually did not grow very much. So the difference between the total reserve and required reserve is the excess reserve. The excess reserve are basically money that is sitting in the bank waiting for people like Coney Jones to walk in to borrow money. Okay? And remember, unless there are borrowers like Coney Jones who then take the money to spend, then all this excess reserve is just sitting there doing nothing. When we look at the bank loans, we have seen a sharp contraction and then a recovery. After that is pretty much lackluster, right? This also confirmed that there were not a lot of bank loans given out, and the velocity of money just didn't grow. Aside from uh, the group that owns stocks and benefited from the stock market rally, who had benefited the most from all this? Surprising or not surprising to some people, the answer is the government. Right? Because government are net borrowers, they issue bonds. And to the extent that interest rate on these bonds have come down, government are paying less in interest rate. So government benefited from this. So who pays the price? Well, the flip side of borrowers, the lenders, right? The people who lend money to government, the institution or the people that own government bonds. So you can see that in the case of United States, the central government benefited from the improvement in their net interest income, meaning that they pay less in interest, and the group that has suffered, right, meaning that they earn less interest, would be the insurance and pension fund, household, and the rest of the world. I want to take a 20,000 feet perspective and visualize the cost benefit of QE. In the beginning, when the economy crashed, I think that the QE is justified and it makes a lot of sense, right? As if we have just witnessed a car accident and the victim is in a shock, and we have no choice but to pump in morphine to calm the victim and to uh, to numb the pain. Right? So this is what QE has done to the stock market. The Fed was able to take out the uncertainty premium by lowering interest rates and create the wealth effect on consumption. However, as the Fed continue with more and more QE over time, more and more QE over time, then the marginal effect start to turn negative, right? Pulling down the overall cumulative effect. More and more QE distorted asset allocation. Okay? When interest rate is very low, people are forced to invest in riskier assets. And this has distorted incentive. When interest rates are very low, it encourages companies to borrow money, not to invest in factories, but to borrow money to buy back their stocks, financial engineering, right? And that is distorting incentives. And when interest rates are lower, the long-term investors like pension fund, they are getting less interest. When they're getting less interest income, right, what it means is that they are going to face a shortfall in the amount that they're expected, right, when they need to pay off the pension. So this makes the pension fund deficit a lot worse. And when you have the rich poor gap widening, it creates more inequality. And when we lower interest rate too much, what happens is that the bank's profitability becomes a major concern. When interest rates are too low, it not only distort incentive, but it also encourage risky risk taking, and it also encourage leverage. when company borrow money to buy back stocks, their leverage goes up. And having more and more leverage is not necessarily a good thing for a country. This concludes this segment.